This is, from my perspective, early contender for chart of the year for next year. It's not fully enough developed at this point to say it's a key for this year, but I think as we watch next year, this is going to be something we keep going back to. Welcome, everybody. Willie Delwich here. Welcome to Townhall Takeaways, where we try to distill the conversations, the market developments, the news of the week into a few takeaways, just a couple bullet points, something to focus on as we move forward, as we, in this case, start to wind down 2022 and start to think about 2023. A couple things to think about this week. We've had some volatility. We've had some rally attempts, some sell-offs. I think one of the really key takeaways right now is if we're going to get a sustained rally, yes, we need to see higher highs from a price perspective. We need to see more new highs and new lows from an individual stock perspective. I think another one of the missing ingredients is starting to see some optimism on the part of individual investors. We can talk about the persistent pessimism that we've seen in the AAII survey at a record level of weeks of more bears than bulls now. We can talk about it from the perspective of the NAIM survey. Active investment managers, at each rally attempt, as we've gone over the course of this year, they've peaked with less and less equity exposure in their portfolios. But today I really want to think about it from the perspective of advisory services, investors intelligence data, in part because it illustrates the point really well, and in part the sentiment now is very similar in terms of the investors intelligence data to what we saw in another period where we were in a downtrend where we had some rally attempts that couldn't clear key levels. And stocks were weak for a while. Thinking right now about the second half of 2015, early part of 2016, they're similar to now from a sentiment perspective. You had an initial rebound in optimism that then fell apart, and you actually had a return to pessimism. From an investor's intelligence perspective, you went from more bears than bulls to back to optimism. You saw bulls expand, but then early 2016, you saw that actually lower low in terms of pessimism. You saw more bears than bulls on the survey, and basically the S&P chopped around for a while as it tried to find its footing. That's similar to what we're seeing right now. We've seen lower highs and lower lows, reclaimed those summer lows, but haven't been able to take out those summer highs on the S&P yet, and we also haven't been able to take out the summer high from a bull bear spread perspective either. I think what's important is what happens after that takes place. So we've seen what happens when we don't have this expansion in optimism. In the case of 2016, once we eclipsed those initial peaks in terms of optimism that broke out to a new high from a bull bear spread perspective, that's when the rally really got in gear over the second half of 2016 into 2017, which, by many accounts was one of the best years in the market. Their optimism was continuing to expand. You had the bulls necessary that were necessary to have a bull market. That's one of the missing ingredients in this environment. And so, yes, at an extreme, we can talk about too much optimism, and people for some reason like to talk about climbing this wall of worry. I've never really been able to make much sense of what that actually means. From my perspective, what we actually want, if we're going to get a bull market, better price action, better breadth action, and more bulls from a sentiment perspective. Not seeing that yet, and actually seeing to some degree optimism wane again. Saw that in today's data from NAIM, saw that investors intelligence, or it's AAII as well. So need to see optimism come back in. In terms of long-term trends, I think a little bit of historical perspective is super useful for investors right now. If your investing background, if your experience only goes back the past decade or so, you're unfamiliar with this idea that commodities could actually trend higher than stocks up until the last couple of years or so, where commodities have been on a tear relative to the S&P 500. 90% of the days from 90% of the weeks from 2012 into basically 2 years ago, 90% of that time, stocks were in an uptrend relative to commodities. That's not what we have now. And historically, that hasn't been the case. Historically, you have periods where stocks are stronger. You have periods where commodities are stronger. If you switch between leadership, if you're not in so much in love with one asset class that you can't follow a trend, you actually come out ahead, both from a return perspective and from a risk perspective. And so this, from an asset allocation perspective, one of the most important things we can learn from this year and carry with us is this idea that we don't want to fall in love with that asset class. We want to respect the trend. We want to follow the trend. The trend right now, even though commodities as an asset class have rolled over, they're still in an uptrend relative to stocks. So this isn't a time to move from commodities to stocks, at least not yet. At some point it will be, and then again, follow that trend. Don't get caught up loving one asset class over the other. We can see that not just across asset classes, but within asset classes. Think about NASDAQ 100, for example. We've seen the NASDAQ 100 has been in negative territory on a year-over-year basis more over the past 160 days than it had been the preceding decade. Investors forgot that NASDAQ stocks can be in the red. And so if they've piled in assuming that they wouldn't be, that's been a painful experience this year. We can look at it internationally, where the US has been in a period of sustained strength relative to the rest of the world. Longest uptrend in the US relative to the IFA in the history of the data going back 50 years. But over the past couple of weeks, that trend has started to change. This is, from my perspective, early contender for chart of the year for next year. It's not fully enough developed at this point to say it's a key for this year, but I think as we watch next year, this is going to be something we keep going back to, that after an extended period of U.S. leadership, global stocks are taking the lead. And again, if all you have is the past decade, that seems like an anomaly that we would see any degree of international leadership. But again, zoom out, get full perspective on history, and there's periods where the U.S. leads, and there's periods where the rest of the world leads. Right now, it appears we're in that period of transition. So again, it's not a love affair. We don't need to love the U.S. equities. We don't need to love IFA equities. We don't need to be tech investors. We don't need to be value investors. We need to respect the trend and follow where the trend leads us. That's the pathway to long-term success when it comes to investing. And that path right now is commodities over stocks. It's bonds over both commodities and stocks. From a global equity perspective, it looks like it's turning increasingly to the rest of the world versus the U.S. So those are the takeaways. We need bulls if we're going to have a bull market. And don't fall in love with asset classes. Don't be hostage to a narrative that keeps you there even when the trend changes. And right now, we look around the world, in the U.S., globally, plenty of trends are changing to keep us on our toes, keep us on our feet, and keep us leaning in the direction of opportunity and away from risk. So those are the takeaways for this week. Thanks for joining. Willie Delwich here. I do this every Thursday afternoon. I'll do it again next Thursday afternoon. Take care, everyone.